everyone, welcome back to the course Introduction to Financial Accounting. Today we will learn Lesson 3, focusing on accounting cycle and double entry bookkeeping. These are very vital. They form the backbone of financial record keeping and are essential for maintaining accurate financial statements. By the end of this lesson, we will have a solid grasp of how business record their financial activities. Let's get started. Before we dive into the key content, let's go over our learning outcomes for today. By the end of this lesson, you will be able to understand the steps in the accounting cycle, identify the role of bookkeeping in financial record keeping, recognize and record transactions in a journal, differentiate between single entry and double entry, and be able to understand how debit and credit transactions work in double entry accounting. And with this, classify financial accounts into 3 fundamental categories. So let's begin by understanding some fundamentals of accounting cycle. Accounting cycle is a step-by-step process that ensures financial transactions are accurately recorded and reported. It consists of several phases, from identifying transactions to preparing financial statements and closing the book. Understanding this cycle is crucial for maintaining organized financial records and ensuring compliance with accounting standards. Accounting cycle, by definition, is a collective process of identifying, analyzing, and recording the accounting events of a company. Understanding these steps ensure accuracy and consistency in financial reporting. The accounting cycle consists of 8 steps, beginning of identifying transactions to close books, but they can further divided into 2 categories. From step 1 to step 4, they are bookkeeping steps. From step 5 to step 8, these involve adjustments, preparation, and closing tasks, so they are typically accounting activities. Mastering these steps ensures business maintain accurate and reliable financial records. The first basic topics: bookkeeping. Bookkeeping is the foundation of accounting. It refers to the systematic process of recording all financial transactions, income, spending, and revenue, and other related financial obligations. So the key purposes of doing bookkeeping are to ensure accuracy, compliancy, making it easier to complete each step of the accounting cycle effectively, and also to ensure that all financial transactions are recorded accurately and communicated clearly. The key features relate to tracks all income and expenses, forms the foundation for preparing financial statements, and ensures regular compliance. At first glance, bookkeeping and accounting may seem interchangeable or quite similar. While it may be easy to confuse these two, they are not the same. Accounting is the umbrella term for all processes to business financial transactions, whereas bookkeeping is an integral part of the accounting process. Think of bookkeeping as the process of capturing data, and accounting as the process of transforming the data into meaningful financial returns. Use bookkeeping record to make financial decisions and create business strategies. Bookkeeping provides the raw data, and the accounting process this data to create meaningful financial outcomes, i.e. financial statements. Common examples of bookkeeping include recording financial transactions, posting debits and credits to a journal, preparing financial statements, processing payroll, and so on. On the other hand, activities include reviewing and analyzing financial statements, preparing adjusting entries, performing audits. Without bookkeeping, accountants would successfully provide business owners with the insight they need to make informed financial decisions. Here is some of the transactions or activities that ask you to identify are they bookkeeping activities or not. So let's take a look. These very core activities are directly related to recording financial transactions, while others belong to broader financial management or business strategies. So students in a class the moment to review these items and identify yes or no answers. The answers are attached here. The answers that are yes are those things that including maintaining ledgers, payable and receivables, invoice processing. But on the other hand, some other activities are not bookkeeping tasks because they involve analyze, planning, or decision-making rather than recording financial transactions. This exercise is quite useful and quite fundamental. Students need to be quite clear in order to move forward to the next level of study. To be able to do bookkeeping, there are some documents students need to be aware that are used for bookkeeping evidence. In bookkeeping, financial transactions must be supported by documentation. This ensures accuracy, accountability, and compliance with financial regulation. These documents serve as evidence of transactions recorded in the books. For example, the first one is the cash book. The cash book records money spent by customers when a contract is signed or sale is done between the business and their customers. This is issued when a business sells their goods or services. It serves as proof of income and is essential for tracking revenue. Purchase invoices is different from sales invoices. These are received when the business purchases goods or services. Again, they are evidence of expenses and help maintain accurate records of account payables. Bank statements, very important, need to be kept for business as evidences. They tend to provide a summary of all transactions in a business account, including deposits, withdrawals, and payments. Another one are receipts. Receipts confirm payments made by customers or is paid by the business. They're essential for verifying transactions and maintaining accurate, having proper bookkeeping evidence, financial reporting, and ensuring the integrity of business records. Always keep these documents organized and accessible. In today's digital world, businesses no longer need to rely on a manual bookkeeping method such as handwriting journals or Excel spreadsheet. This can be very time-consuming work, and you can afford to make too many mistakes. Instead, they use bookkeeping software to automate and streamline financial record keeping. Bookkeeping plays a crucial role in maintaining accurate financial records and is the foundation for final outcome, which is the financial reports and decision making based on this information. This is laying the foundation for further accounting activities. So using bookkeeping softwares can significantly make the process very, and there are many benefits including listed here: efficiency, automates data entry and calculations, reduce human errors. Accuracy ensures financial transactions are recorded accurately. Accessibility. Many platforms offer cloud-based solutions, allowing users to access financial data from anywhere. And in integration, synchronize with banking systems, payroll system, and invoicing tools for seamless experience. Some of the popular bookkeeping softwares are listed here, including, for example, very popular QuickBook Online. Great all-around software for freelancers and small business, seamlessly integrating many functions, including connection to accountants and connection to tax authorities and so on. Zoho Books offers a free version and integrates with various apps as well. FreshBooks is another very popular one, best suited for service-based businesses. Xrow, one of the most widely used cloud-based accounting solutions. QuickFile, a free bookkeeping solution for all users. Ultimately, the right bookkeeping software can help business stay organized, improve financial transparency, actually can reduce cost, and also save time. If you are interested in comparing different software options, you can check out those links that I have attached. Not all business activities qualify as transactions as mentioned. By definition, a financial transaction occurs when there is an exchange of value. When there's examples include purchasing, selling, and loans. And for example, signing a contract with a supplier does not immediately count as a transaction because no money has been exchanged. However, making a payment under that contract does qualify as a transaction. So in the accounting cycle, the first and the most crucial step is identifying transactions. Now, every business activity qualifies as a transaction, so we need to determine which events should be recorded in the financial statement. Definition of a transaction. A transaction is a completed agreement between the buyer and seller to exchange goods, service, or financial assets in return for money, or their business economic events recorded by accountants. They can be external. Not all activities in a business represent transactions. And fundamentally, and this would be very important for future studies, each transaction has a dual effect. This is a little bit more counterintuitive because for our normal non-accountant understanding, each transaction would have a name and in or out in terms of payment. But in terms of accounting thinking, we need to recognize that each financial transaction in a business has dual effects. That we are going to elaborate on this principle later on. So the external transaction with an example, internal transaction example relates to recording depreciation. So this dual effects are very important aspect that we're going to discuss. How to identify a transaction? To determine if an event qualifies as a transaction, I summarize them here. You need to ask 3 questions basically. There is also definitions I have introduced. So the 3 questions should be, does this event involve an exchange of money, goods, or services? So it cannot be only financial gains or loss. It can be goods or services. Secondly, does it impact financial accounts, such as assets, liabilities, or equity that we're going to study as well? The 3 types of accounts. Is there a supporting document? We mentioned earlier a couple of different types of such as invoice, cash book, receipt, bank account transactions, and so on. If the answer is yes to all these questions, then we have a solid evidence that they are very much likely to be financial transactions that need to be recorded. This slide shows transaction hand group activity can be done in class with a pair of students or a small group. So the question is, first, if you don't recognize a transaction in your bank account, what can you do? Students can imagine if they have a bank account set up and if they notice some of the unrecognizable transactions, this can happen quite easily. And what step they can do to reconcile this and where they should be reporting to. So verify the transaction details normally. You can check report evidence, your bank account transactions and receipts and so on. Also contact the bank normally for further details. If it is a very suspicious transaction, they need to be reported very immediately. And being able to identify and verify transactions is essential for financial accuracy and also fraud prevention. This applies to individuals as well as businesses. So now we can analyze some of the events and identify in groups if they are transaction or not. This is very essential for our further study. So the first one, purchased goods using cash. Does this impact financial accounts? Yes, they do, because purchased goods would have cash in or out. Therefore, it will impact the cash account. Purchased furniture using cash, again, it's the same thing. You got furniture as your assets, and you have to pay $2,500 for this furniture. Another one is legal fee paid. Again, it's a transaction. Need to be recorded. Next one, hired Miss Zhou as office administrator at $1,500 a month. This is not a transaction. Is hiring an employee an immediate transaction? Is not an immediate transaction. It's just an agreement. Finally, sign a contract with suppliers. This is more obvious that signing a contract does not relate to an exchange of money or services yet. It is a contract being signed. So a further question can be asked, can you think, or students think of other examples where an event may seem like a transaction but isn't recorded in the books yet? So it's important for students to understand now every business activities in the accounting transaction. A transaction must involve a measurable financial exchange, be supported by evidence. If there are no invoices, then you need to look into this receipt. It's your turn. Now let's put some concepts into practice. Debbie's dairy farmer. Debbie's dairy farmer experiences several financial events. Your task is to determine which ones qualify as transactions. Consider whether there is a financial exchange, whether ownership changes, and whether the event impacts the business financial records. There are 4 events. Which event you think should be recorded in the accounting system? The first one is Debbie ordered shelving worth $750. In this case, Debbie did not yet receive the shelving. It was just ordered. Since the shelving has not yet been delivered, Debbie does not owe any money to the other company. So we consider it not a transaction. We do not record it. The second event, Debbie selling price on a gallon of milk is $3, and she changed it to increase to $3.25, and her employee puts the new price sticker on each gallon. Changing prices does not have an impact on the company at the time the price is changed. It will impact the company in the later transactions, but when putting stickers on milk gallon does not incur any transactions. Debbie still has all the milk and has not received any money, so it's not a transaction. We do not record it. The third example, a customer buys a gallon of milk, paying cash. So Debbie now has a transaction to record because she has received the cash from this transaction and the customer has gotten some of her inventory milk. She has an increase in one asset, cash, and a decrease in another asset, inventory. She needed to record this transaction. She actually earns some revenue. The fourth event, the shelving is delivered with an invoice for $750. Debbie has taken possession of the shelving and is the legal owner now. This is her asset. She has an increase in her asset, but on the other hand, she has an invoice she needs to pay for $750. Therefore, she actually increases her liabilities as she accepts the delivery of the shelving without paying it. So she has to record this transaction. So the key takeaways are a financial transaction must involve a measurable exchange of goods, services, or money. Just making a business decision, such as setting a price, putting an advertisement, or placing an order, does not count as a transaction until money is spent or received. Identifying what qualifies as a transaction is very important, ensuring the later financial activities are accurate. Once transactions are identified, they must be recorded in a journal. This is an accounting format of recording transactions. This process, called journaling, captures some key elements including the date, the accounts affected, such as assets or liabilities, and whether each entry is a debit or credit. Journaling ensures financial accuracy and helps track business activities. Journaling the entry is the second step in the accounting cycle. Some of the journaling activities are actually done by softwares. Journals have this standard form, the date, the accounts involved, and debit and credit accounts that reflect the due nature of the transaction. Here we have 2 examples showing 2 journals. The double entry system ensures accuracy by recording each transaction in 2 accounts, one debit and one credit. The method maintains the balance in the accounting equation. Double entry bookkeeping requires each transaction to affect at least 2 accounts, ensuring the equation remains balanced. Let's look at these 2 examples. The key element, as I mentioned, of a journal double entry needs to have date, accounts involved, debit and credit, as well as the amount involved, which are showing here in 1, 2, 3, 4 categories. The first example, rent payment on credit, $700. The debit is rent expense, 700, increases in expense. The credit is account payable, 700. This is a liability. So liability increase since rent is unpaid. We record this transaction as rent expense occurs as well as account payable occurs. The second example, selling merchandise for cash for $150. So in this second case, we have to do double entry as well. The one is date, second are the 2 accounts. The cash is on top, the sales sold as a merchandise on the bottom, which is the credit. So cash 150 is an increase in asset according to accounting rule needed to be in debit side. And the second one is the sales revenue. It's an income which is recorded from the sale. According to accounting rule, needs to be a credit. Here, cash increases because money was received, while revenue is credited to reflect the sale. So these 2 very simple examples illustrate how journals should be done to reflect the double entry due effect each transaction. To give you the proper definition, double entry is a fundamental concept underlying present-day bookkeeping and accounting, which states that every financial transaction has equal and opposite effects in at least 2 different accounts. Every transaction has dual effects, reflects on debit side and credit side in opposite directions. Double entry is very vital. I have a question that students could discuss. Why do you think double entry bookkeeping was such an important practice in business? Let us take a step back in history to understand where modern accounting principles come from. The concept of double entry bookkeeping, which we use widely today, was not a practice that coming from nowhere. It was first formalized by an Italian monk and a mathematician named Luca Basilio over 500 years ago. He was a mathematician and Franciscan monk. He collaborated with other people such as Leonardo da Vinci on mathematical studies and wrote the book Double Entry Bookkeeping in 1494. The book is called Summa de Arithmetia. Why is he so important? Because he used this for the first time and documented for the first time as well. This particular practice is very mathematical and is not very intuitive. His work helped many businesses at that time standardize accounting and laid the foundation for modern financial reporting, banking system, and financial system. The principles he described, debit and credit, ledgers, and financial statements, are still used today. For a deeper look at Luca Paciolio's impact, you can click on the short video and watch it on YouTube. To wrap up and answer the question we asked earlier, why double entry is so important? Why is it important to always have a corresponding debit and credit in journal entries? There are some suggested answers. I mentioned some of them earlier. Ensures accuracy and prevents errors. So double entry catches mistakes that single entry could not do because the total debits must always equal total credits. Secondly, maintains financial balance. Without a balanced system, the accounting equation would not hold, and also it will be impossible to produce financial reports, and it enables better financial tracking as well. The system helps to identify trends, profits, losses, and financial health over time, and those figures could be compared over time and across different industries. Fourthly, it reduces fraud and increases transparency. Since transactions must be recorded twice, fraudulent or unauthorized entries are harder to manipulate. and it's required for financial reporting and compliance. Standard accounting frameworks such as GAAP and IFRS we mentioned in our previous lessons mandate the double entry system, not the single entry system. So this helps to comply with tax regulations and prepare accurate financial reports. Here we have an example is a single entry to compare with the double entry. Small business may use single entry bookkeeping, but most business, particularly standardized corporations, prefer double entry bookkeeping because it provides a more accurate financial picture and many other benefits. Let's compare the two methods a little bit. Example here on the right shows a single entry cash record where we see cash movement mainly. Money coming in, such as sales interest received, and money going out, such as expenses, inventory purchases. Final balance calculated at the end of period. This is very much like the bank statement, personal ones that people have bank accounts tend to look at the end of each month. So these are normally used for small business owners, freelancers, and sole operators. Businesses with low transaction volume and simplified financial reporting needs could use this kind of single entry accounting system. It's relatively speaking quite easy to do and quite easy to understand as well, but clearly it lacks the complexity and the rigor and a lot of benefit comparing to the double entry for many bigger business, particularly modern, very complex business. This slide summarizes the comparison between single entry and double entry bookkeeping. In summary, single entry is simpler to use, and most small business with very low volume of transactions could use it. And it only tracks only cash flow tend to be related to assets. But on the other hand, double entry need to record more complex system, two accounts instead of just cash flow one account. And also it need to ensure the accounting equation balances. Basically, accounting equation holds true, assets equals liabilities plus equity, which single entry would not be able to reflect. There's some other differences as well. Even though single entry is simple to use, but it has no ability to track some of the errors or frauds, and it has a higher risk of mistakes as well, and doesn't comply with financial regulations. So here let us focus on the double entry bookkeeping method, the fundamental principle of double entry, and so on using examples. So every transaction has two effects that balance the account. Examples showing here. The first one, purchasing a car with cash for $1,000. So in this case, you need to fund two accounts. There are first one, increase in asset. So two accounts, we highlight them here. First is purchase a car. This is an increase in asset. The second one is $100 cash to paid out. This is a cash. Cash is another asset, but it's being paid out. That's example one. The first one, increase in car. The increase in asset as car is a debit, and then decrease in cash in another types of asset is recorded in credit side. The second example, if instead the car is purchased on loan, not purchased by cash, therefore there are some similarities. The first one is still a car being purchased, so it's an asset recorded on debit side. The second one is a liability because it's a payment in the future. So all the bank $1,000, therefore is called loan payable and is a liability and being recorded on credit side. Another example, paying for a car repair $50. This case, increase in expense, pay a garage. So that's the first one, increase in expense, and the expense is debit called repairs expense. And the second one is a decrease in cash. So this £50 is used to pay off this expense. So that's second one. In this case, you paid $50 to the garage, which is a credit decrease. Therefore, is recorded on the credit side. So here we have another question. Which account should be on debit side and credit side? We had looked at a little bit briefly in verbally and in written as well, but now we want to put them into a journaling style. So to answer this question, we need to be clear what credit and the debit are exactly. So what exactly are credits and debits? In this photo, there are two buckets. Can you identify which bucket which has 100 US dollar in and the other one is 100 US dollar out are credit and debit? These are the principles of credit and debit. So they are in opposite directions, showing in the money in and money out. So debit in this case, actually, the left bucket, which is money coming in, increase cash and increase assets. This is debit. And the second one, the one has got on the right hand side, right bucket is money going out, which increases liabilities. Actually, it also decreases assets, therefore is credit. So, for example, if a business takes out a loan, cash increase, but liability also increase. Therefore, the cash increase is debit, and the loan liability increase is the credit. So these are some fundamental principles that underpin what exactly are debits and credit. So in summary, debit and credit reflects the duality or double-sided nature of all financial transactions. So debits, often represented as DR, record incoming money, while on the other hand, credits as CR record outgoing money. So two directions in opposite direction. These two things are very important. When we try to figure out credit and debit, we need to know the first, the direction of the money. They reflect the directions of the cash, or sometimes if it is not cash, they can be called economic benefit, goes in or coming out, the direction. Secondly, name of the accounts or categories in accounting terms, because in accounting there are many accounts. But fundamentally, there are only three categories of the accounts. They are assets, liabilities, and equity. We'll elaborate on these three types of accounts later on. First, the direction of debits and credits using the bucket analogy that you can see from this photo. So debit represented by D represents an increase in asset or expenses, thinking of it as money or value flowing into the bucket, and this would record on the left side of an account. Always, debit is recorded always on the left side of an account. And the credit, CR, represents an increase in liabilities, revenue, or equity, thinking of it as money or value or economic benefit flowing out of a bucket, and this is recorded on the right side of an account. This is essential for balancing financial records, and the double entry is maintained. So to summarize, a debit is an accounting entry that increases assets or expenses, and on the other hand, decreases liabilities or equity. Credit is an account entry that increases liability or equity, decreases assets or expenses. So debit, DR, is the economic benefits flow into the bucket, which increases the assets as well as the expenses. And the credit is the economic benefit flow out from a bucket, therefore increase things such as liabilities and equity. Remember, we mentioned there are many accounts, but only three categories. These are assets, liabilities, and equity. So the accounts categories are very essential for organizing financial transactions into categories. Every business record transactions, but to make sense, we classify them into special account categories using special name. So fundamentally, an account is a category used to classify and organize financial transactions. Instead of listing every individual transactions in their original records names, we put them into categories, i.e. accounts, in order to track the movement of this one particular type of account. All accounts fall into three main categories, which are then further divided into 5 extended categories. So these are assets, liabilities, equity, and further categorized into revenue and expenses. Revenue and expenses belong to equity. This page I summarized a very essential accounting rule that help you to remember what accounts increase in debit side, what in credit side. The whole page shows quite a lot of essential information that students need to remember. So the first is the extended accounting equation, which is asset equals to liability plus common stock minus dividends plus revenue and then minus expenses. The 4 items, common stock, dividends, revenues, and expenses are all equity, but because they do different directions, therefore they will put into different sides in accounting equation as well as double entry. So the rule shows ADE increases on debit side. So A represents asset, D dividends, and E expenses. These 3 accounts increase on debit side. The second part of the rule is LCRE increases on credit side. L liability, C common stock, R revenues, EQ equity. So this equity is the positive equity. Here is an example that asks you to categorize different types of accounts when they increase or decrease. Do they go to the debit side or credit side in a double entry journal booking? The steps to break down should include 3 steps. The first one, identify the category of each account. So 5 categories: asset, liability, equity, revenue, or expense. Step 2, determine if the account is increasing or decreasing. Step 3, apply the essential rule that I just introduced in the prior slide. So accounts increases on debit side are AD expense. Accounts that increases on credit side are LCR equity. The answers are showing here. The key takeaways are debit increases on asset, drawing, and expenses. Credit increases on liability, capital, and revenue. So capital is the kind of equity. Every transaction must balance with equal debit and credit. Here is another example that give you some very basic double entry transactions. We will go through the 4 examples one by one. This page shows the analysis of the transactions using the bucket analogy to understand how debit and credits work. So bought furniture for $600 in cash. If we break down the transaction, you can see there are 2 effects. You purchase the furniture worth $600. This is the first part of the transaction. You pay £600 cash, $600 cash. This is the second part of the transaction. Since you gain an asset, which is the furniture, we debit the furniture account because asset increase on debit side according to the rule we just introduced. And since you giving out some cash, which is categorized as another asset, we credit it because cash as an asset decrease on the opposite of the debit, which is the credit side. So these are 2 visualization of the debit and credit. And if you go back to the 3 rules, that step 1, categorization, step 2, identify increasing or decreasing, and step 3, use the ADE versus CLRE rule, then you can get this double entry quite correctly. So here is the answer to question 1. The key takeaway is debit increase asset when value flows in, showing in the bucket. credit decreases, one asset is out. Basically, in this case, money is out, but another asset is coming in as a furniture. Again, every transaction must balance, meaning total debit must equal total credit. Here is the second example. You take out a bank loan of $1,000 now. This is another very common business transaction. Taking out this loan, which is a liability, you can record this in two effects. One is liability increase. The other one is you got some cash from this loan, but this cash need to be repaid in due time. In this example, the business received 1,000 cash because of this loan, and at the same time, the business has a new liability. This means one asset as cash increases, therefore it's going into your bucket. One asset increase, it should be on the debit side. And then the other one is liability increase. Remember, we have the principle, the rule. When liability increase, it should be on the credit side. So here is how you record it. So cash is on the debit side, and loan or liability is on the credit side. And the buckets at the bottom show how this is visualized. Example 3 is a sell for cash, $1,000. And again, the debit side is you get some cash because of this transaction. Therefore, asset increase should be on the debit side. And secondly, you made some sell worth $1,000 as well. Sell is revenue, and using the principle we just specified, LCRE increase on credit means liability, common stock, revenue, and equity increase on credit side. This is how we record it. So you can think a question, what would happen if the sale was made on credit instead of cash? So how would you record this in the journal? Slightly different from this transaction, which is the one in example 4. So example 4 is again a sale, but it's on credit. That means the sale is made, but the money is going to be received in the future. It's not going to be received now. That's what on credit mean. And this future is not a very long future. It should be quite quickly, in a couple of months on normal standards, depending on the terms of the contract. So how to record this one? In this case, again, the sale, the revenue is still on the credit side, which is on the lower level of this table. And then what is on the debit side in this case? In this case, there is a special term called account receivable, means money is going to be received soon. So it's not cash yet. It's kind of cash, but it's cash going to be received in the near future. It's still an asset in terms of accounting category. So according to the rule, asset increase on debit side. This is how you record it. So to sum up, the 4 examples show some of the very common transactions and help us understand how double entry should be journaled. So the first one, bought furniture for cash. The second one is a bag purchased, sold in cash. The third one, receive a bank loan with cash. So it's liability and cash. The final one is a sell on credit, which is the account receivable asset on debit side and revenue on credit side. Relates to the increase and decrease in terms of the double entry, debit and credit, I introduce another very important concept, which is called the normal balance. The normal balance of an account is the expected balance it maintains. This is the side, no matter debit or credit, that causes the account to increase. Therefore, for example, for account ADE expense, their normal balance would be debit. For account LCRE equity, their normal balance would be credit because they increase on credit side. For a couple of accounts, the normal balance are showing here. So if you look into the first one, asset increase on debit, therefore debit is assets normal balance. And if you look at the final one, which is expense increase on debit side, So debit is the normal balance of expense. This table below summarizes how different accounts behave with debit and credit. You can use this one as a guide when analyzing transactions. Let us use these questions to test our understanding of the normal balance of different accounts. There are a couple different accounts. We can go through each of them and determine whether its normal balance is a debit or a credit using the accounting equation as your guide. Remember the rule: debit increases on ADE and credit increases on LCRE. There's a special term called retained earnings. Retained earnings are equity. We can see what the normal balance is for this special account. Here are the answers. Asset, dividends, and expense, their normal balance are debit. And liability, capital, and revenue, their normal balance is credit, which is listed in this blue box. So we mentioned the retained earnings. Retained earnings are equity. So equity increases on credit side. Therefore, credit is the normal balance for retained earnings. So in summary, these are what we studied today. We studied what accounting cycle is and identified the key steps involved in bookkeeping, which is different from accounting activities. They are the initial stages of accounting cycle. We identify the transactions and understand how transactions need to be journalized and differentiated between single entry and double entry bookkeeping methods. Double entry is very fundamental to accounting and finance and laying the foundation for modern financial reporting. Understanding credit and debit are very important in keeping the double entry method. We also looked into some of the accounts that are very important in double entry. Three of them are the fundamental ones. These are asset, liability, and equity. And with extended ones, we also have revenues and expenses. And particularly, I introduced the essential accounting double entry rule, which shows that ADE increases on debit sides. This is the normal balance for this account, and the LCRE increases on credit side, and credit side is the normal balance for this account. So here I have a list of review questions a student could look at and reflect on the content we have studied for today. Finally, some homework again, and then the key textbook reading with links as well. There are also a couple of quizzes that are very useful and very simple. I encourage using short times in class and before the class and after the class. Students can work on those quizzes. So that's it for today's lesson. Thank you for participating and hope you enjoy this, and I hope seeing you next time as well. We will explore more advanced accounting concepts and principles, and feel free to send a message to me if you have got any questions. Thank you and see you next time.